What's up, everybody? Jamel Gibbs. Got my man D'Andre Clayton here. And as you guys know, we do a ton of video content together. Today, we're going to do something slightly different. Now, D'Andre has a video he wants me to react to. I haven't seen the video yet, but I do know what the topic is about. Good debt versus bad debt. And Dave Ramsey is the one who put this video together initially. So we're going to go ahead and react to this video. Again, I am not privy to what's in this particular video, but I have my own thoughts about how I feel about good debt versus bad debt. So let's get into this video, man.
Hi, Dave. Hope you're having a good day.
I am, sir. How can we help?
Is there such thing as good debt if the interest rate is low enough? Would it be better off to pay off some low interest debt or let the money stay with those investments and, they make money in those investments that is greater than the interest rate, I guess is the way to describe it.
It's a great question. I used to kind of subscribe to the same thing because I'm a math nerd, and the idea that if I could borrow, if my mortgage rate is 3% and I can put money in a mutual fund and it makes me 10%, then I made a 7 spread. Why would I not do that all day long?
All right, so I had to stop it just really quick. So, one, he talks about being a math nerd right here in this spot, but I think what we're forgetting is, he made it seem like interest is linear across the board. I don't know if you kind of caught that.
Yeah, I did.
Like, is a mortgage 3% the same as a mutual fund 3%?
It's not, man.
It's not.
No, it's not.
I was trying to figure out how does that play in the role, but hey, you know what? Let's just go ahead.
Yeah, another thing I want to add to that too. He just said if he was getting a 7% spread on a return,
right?
Would it be a good idea to invest the money versus pay off the debt?
Right.
Let's put this in real estate terms. In real estate terms, you're gonna have, let's say, a 3% mortgage, but then you got other benefits that come with real estate as well. So you got the depreciation, you got appreciating value, you have appreciation in value of the real estate, right? You got tax benefits and things like that. And some people might argue that, all of those benefits are not, they pale in comparison to the property being paid off. But in reality, they don't. If I'm making a 7 spread on my investment and my, let's say my interest is 3%, but I'm making 10%, which gives me that 7 spread. At the end of the day, I'm going to let that investment pay for the liability all day long.
Absolutely.
You know what I mean? That's called leveraging debt. And it sounds like Dave is not a fan of leverage.
Absolutely. That's a good point. I think, and that's the reason why I asked about it being linear, at least from an interest standpoint, because the other part that you mentioned, there's so many components to leveraging debt when you're talking about renting out a property or something like that, and having that appreciating asset while also being able to write it off. Really changes what the growth is on it for you. It really changes what the benefit is for you, because it makes it seem as though your income is less than what it really is while you're drawing income that was added as far as the cash flow is concerned. So you're really not getting just a 3 to 7% spread based on that. So I thought that you would have a little bit of insight on that, just because I know how you feel about that. So let's just kind of mull through it and see what else you got to say.
Let's go through
in reference to this. All right.
What I discovered, and you're a new listener, so you don't know the whole stinking story, but I started buying and selling real estate in my 20s, starting from nothing. I had $4 million worth. I was a millionaire when I was 26. Then I lost it all because the loans got called by the banks, and my theory of making the spread all went to kaput because I got zero out of it. I ended up bankrupt at 28. And I got the opportunity to start over, which made me question my former theories.
So here's the deal. I have the same, almost virtually the same exact story. Now, I don't follow Dave Ramsey. I don't know what his belief system is. I do know how he feels about debt, but I have almost the same exact story. Yeah. So I had over $1 million in real estate at 25, and I lost it all by 27. But I made it all back by the time I was 30 due to leverage. I understood what not to do. He took it and said, okay, now I'm going to just go ahead and pay off all of this real estate. I took it and was able to scale it back up in 3 years due to leverage, which is basically a loan. Through loans and being able to multiply other people's money, that's how I was able to build my portfolio back up. So I just wanted to add to that.
When you have to kind of understand his strategy of, just no debt at all, it takes a certain amount of capital up front to have.
And most people don't have that.
To never have any debt that you take out,
right.
Whether it be on your actual mortgage or home. Most people are not coming to the table with $500,000 in their hand to buy their home. No matter what their income is, it's just usually not the case. So I think when we're talking about this leverage and debt aspect, we have to understand that it's at different levels, right? Mm-hmm. So yes, a hyper or deca millionaire will be able to say, yeah, I have hundreds of millions of dollars, I have tens of 20s of millions of dollars. I don't have to take out debt to buy a warehouse, right? I think what was weird, though, was when we talked about the comparison, he really pointed to the risk being the warehouse that the guy had.
Yep.
Which I thought was kind of interesting because obviously, that's what the guy does for a living. He already has a functioning business. And yes, there's a risk to business, but when you start off comparing it to mutual funds, that's more of a speculation. Right. And anybody who has done a consult with me, I actually don't believe in high risk, high reward. I believe that, if you're investing means that you vet properly whatever you're investing in, and therefore the risk drops because you understand what you're looking at and you've run your comps to go forward and then put your money into it.
Leverage is basically calculated risk.
Calculated risk, right? So I think that calculated risk is where you have the highest degree of return.
What I had left out of my theory, what most people leave out of this theory that you and I are discussing, the 3% versus the 10% mutual fund, the 7% spread appears to be there. What we leave out of that theory is risk.
Sure.
And mathematically, if you install risk into the equation, it starts to dilute or do away with the spread. Yeah. In other types of investments, in sophisticated investment analysis on, for instance, an aggressive growth stock mutual fund compared to a growth and income stock mutual fund, the aggressive is much more volatile, much more risky. The traditional mutual fund, the growth and income, is much less risky, has a lower peaks and valleys if you chart it. So you might make a 10% on that growth and income, you might make 22 on that aggressive, but you don't compare them the same because we don't compare the roulette wheel with a CD.
Sure.
We adjust for risk. And what happens in what you're discussing is we forget to adjust for risk. So I learned the hard way that risk is real, and people learned it again in 2008, and they learned it again with COVID this year, that risk is real, and that when you have debt, you are susceptible to getting your freaking head taken off.
I want to know where the risk was at with the pandemic.
And yeah.
I want to know where the risk was at with the pandemic, because if you ask me, you can't compare 2008 to what happened over the last couple of years with the pandemic. In 2008, people were underwater on their properties.
Absolutely.
Because of the pandemic, people have a ton of equity in their properties. So I don't know where the comparison is with that. Maybe I'm missing something.
Yeah, no, I completely agree with that. Now, it's funny because there were really good points that he had here, right? And I just don't think he applies it to everything. So there's a little bit of contradiction.
So you're saying he picking and choosing?
Yeah, there's a little picking and choosing. Because, if you talk about what he was talking about as far as the risks and making room for risk and saying that, hey, if I said, hey, this is going to be a 7% spread, well, I'm comparing one that's highly volatile versus one that's fairly safe, and that they are apples to oranges. That's what Dave is saying in this case. So you can't really compare them, which is interesting because if you watch a lot of his insurance content, he's constantly comparing the returns of an insurance policy to a mutual fund.
You can't do that. It's not apples to apples.
He's constantly comparing it to a mutual fund, but he's not even willing to compare growth and income, mutual fund to another type of mutual fund because they're apples to oranges. So it's just kind of weird to see him even kind of approach that from that standpoint, which I thought, well, that's interesting, because if you watch a lot of his content, it's like, all right, well, this costs this much, this costs this much. Well, you can put all this in the mutual funds. And he never makes room for the risk in the mutual funds. Then he just says, it will do this, it will do that. But in this case, he's making it out that real estate is more dangerous, so to speak, than even mutual funds, which I find that wildly
That's crazy. That's
right.
Absurd. That's absurd, man.
I find that to be absurd, right? And the reason why I find it to be absurd is, even if you talk about, okay, there was a housing market crash in 2008. If you're talking about the average circumstances that happen, usually it's almost a guarantee that the property is going to raise in value. I don't think anybody would disagree with that.
I mean, over the last 10 years, we've been averaging 3 to 4% easily. Yeah. And if you look at the values of homes from, let's say, the year I was born, I'm 42, now to today, I wish I could buy them for those prices from when I was born. Right. You know what I mean? So I don't understand where he's coming from with this, but let's keep watching.
So I consequently decided to be and live debt-free as the shortest path to becoming and staying wealthy.
Yeah, well, I can't go, well, that way there is no risk.
Yeah, exactly. Or very little. Sure. There's other risks, but it's not the banks. We're not going to get foreclosed on.
Sure.
At all. Now, do I buy fewer things because of that? Yeah, because it takes more money. I don't have I don't own as many buildings. I own a bunch, own several $100 million worth of real estate nowadays, but I probably could own a couple of billion if I leveraged the same amount of equity into stuff.
Did you just hear what he said, man? I own several $100 million in real estate.
Yeah.
I guarantee you. Guaranteed.
He couldn't save to get there? You don't think so?
He didn't save to get there.
What?
He didn't save to get there, number one. He used leverage, number two. And on top of that, so he actually had debt. I'm assuming that. That's an assumption. That's not a fact, right? Yeah. He had to, at some point, there's no way he saved up several $100 million to buy all this real estate, unless even selling books and all this other stuff that he's doing. I can't see it happening, man. I don't know. Unless he was born with a silver spoon, man. I can't see how he did it without leverage.
He says he wasn't, though.
I'm going to give him the benefit of the doubt. Let's say he wasn't. He said he went broke. He owned $4 million in real estate and went broke, right?
Yeah.
How did you buy several $100 million? I've been doing this for 23 years, bro. Several $100 million in real estate with zero debt.
I don't believe it. He wants us to believe it.
I don't know, man. I'm questioning that.
But then I would be up at night when COVID hits. I'd be up at night when 2008 hits. I'd be up at night when Trump gets crossways with the Chinese. I'd be up at night worrying about how I'm going to make my freaking payments because some tenant didn't make theirs. I might be sacrificing some return, but I doubt I really am at the end of the day, because adjusted for risk, I didn't really lose that much. So I live 100% debt-free. So if you're sitting on some investments and you could pay off all your debts, I would pay off your debts. And then I would use the increased cash flow to begin to build some other investments and not have any debt laying around. Because with no payments, you have incredible cash flow. With no payments, you have incredible peace.
There is some truth to it. Now I'm listening to how he's using the cash flow to be able to build more cash flow, right? Mm-hmm. Which at the end of the day, he's a smart man. And this is me saying it. This is from over 20 years of experience. He's a lot older than me.
You're saying it still doesn't account for hundreds of millions of dollars.
I don't get that part. Number one.
Right.
I don't understand how he did that.
Right.
And I also don't understand, how he figures that this is for everybody, because it's not.
Yeah. No.
His circumstances are completely different than the average person.
Yeah.
You know what I mean? So
that's kind of the reason why we talk about the HELOC method, because the part that I do agree with him about, which I think is the best statement he talks about, is the opening up of cash flow from paying the debt down. Well, he says off. I say down.
Yeah.
I say down. Pay the debt down so that your cash flow opens up on any property where you have somebody there. So maybe right now you're getting $300 as basically your profit or your cash flow on the property. If you start paying the debts down quicker in a more efficient way, then you may be able to make a full $1,200 off of that, right? Now, getting hundreds of millions of dollars of real estate, doing that, you would be doing that quite a bit for that.
I mean, he got a big bag if he doing that.
That's
bro.
a big bag, though. So,
you know what I mean?
But that was just something I thought that really kind of bouncing it off of you and seeing what your thoughts were. Because there were some parts about it, like I said, I do agree with some parts of it. I'm not a big fan of Dave, obviously, but there was definitely some parts of it that's a little bit contradictory and a little bit of talking from his spot. Right?
I agree with that.
And not really talking from the average person who might be trying to get started in real estate or trying to build wealth.
Now, I do agree with some of what he was talking about, but a lot of it is unrealistic for the average person. And those are the points that I wanted to make. Yeah. You know, just listening to it, the average person can't do. It'll take the average person forever to try to do to even save up for one property.
4 lifetimes.
You know, we just went over the numbers, right?
Yeah.
The average person can't save even $100,000 to buy a property. So how can you not use leverage to be able to get to where you need to be?
Yeah, I think it's like over 70% of people who can't even afford a $400 emergency.
You know what I'm saying?
So how we go get to hundreds of millions of dollars of real estate? You know,
even if it wasn't hundreds of millions of dollars in real estate, though, what if it was just your basic property, $150,000 to $100,000 property, and that's becoming uncommon these days.
Yeah, that's hard to find.
You know what I mean? So let's call it a $150,000, $200,000 property. How can the average person save up that kind of money and be debt free? You got to use leverage to be able to do that, which takes some form of debt at the end of the day. Now, I'm not saying that he's not saying to go out and get debt. What he's saying is get rid of the debt as quickly as possible.
He definitely says not to go out and get debt. The only time he suggests that debt is okay is if you're getting a mortgage on your own home, which I think is, you know how I feel about that.
You paying for it. It's a liability, man.
You know how I feel about that. So
it's liability.
Yeah. So that, but that's the only time he suggests that debt is okay.
Got it. So I'm just really getting a chance to listen. I never really paid attention to any of his content, but this is interesting stuff, man. I'm not saying he's right or wrong. You know what I mean? But for the average person, it's not feasible to do what he's talking about, in my opinion.
Absolutely not.
Bad debt is debt that you got to come out of your pocket for, period. Good debt, right?
That's a fact, yeah.
Good debt is something that's going to pay you. Real estate is an example of good debt. If I buy a rental property with debt and it's putting cash in my pockets every month,
absolutely.
Good debt.
Good debt.
If I run up a credit card and I got to go and work to pay that credit card off, bad debt. No. You know what I mean?
It's simple. No. He no. With the matumbo.
That's a no. No. But that's in the simplest form. Good debt versus bad debt. There is a such thing as good debt.
Absolutely.
Good debt pays you. Bad debt takes away. Well, let us know in the comment section what you guys thought about this conversation. How do you feel about what Dave Ramsey is talking about? How do you feel about what we're talking about in this conversation? Are we right? Is Dave right? Are we all wrong? Are we all right? We don't know. I feel like I'm all right. I feel like he's all right. I feel like, you all right. But I'm making a joke out of it. But in reality, how feasible do you think it is to do what Dave Ramsey is talking about? Did we hit some key points today? Let's start a conversation in the comment section. Be sure to like this video, subscribe, click the notification bell, do all that good stuff, and we'll see you on the next one. Take care, y'all.